Now let's take a look at some capital budgeting techniques. These will be things that will help us to evaluate the cash flows that are going to occur or the profit income that's going to occur if we purchase an asset that we plan to use in the long term. The first one we'll look at is called Payback Period, and it just identifies how long does it take to get your money back. Now you see that if the cash flows are equal, we can take the net initial investment and divide by the annual net cash flow. But if our cash flows are not equal, we use what we call year-by-year analysis, and we'll demonstrate this with a problem. But what you want to realize is that when you read a problem, you want to identify if the cash flows are equal over the life of the asset or not, because the way you approach it will differ depending on that. All right, interpretation. A shorter payback period is better. You'd rather get your money back in 5 years as opposed to 6 years. This is easy to compute. It's a good initial indicator because of that. It's easy for managers to understand. Now it does have some drawbacks. You can see that it totally ignored the time value of money. We didn't find the present value of any of the cash flows, and it ignores profitability. All it tells you is how long does it take to get your money back. It tells you nothing about whether you're going to actually earn a profit on the investment. Now our next technique is called simple rate of return. A lot of people call this accounting rate of return. That's why you see the abbreviation ARR there. I like this because if you look at the formula, you take average annual net income divided by the net initial investment. So you can see by using income, this one uses accounting data. So note that all of the other techniques are going to use cash flows. This is the only technique that's going to use income in its calculation. That'll help you remember the formulas. Now when you're evaluating a simple rate of return, you want to compare the simple rate of return to the minimum required rate of return. And if the simple rate of return is greater than or equal to that, then it's an acceptable project. This also is easy to calculate and easy to understand, so those are the advantages. But as you see, it totally ignores the time value of money. So now we're going to turn our focus to a couple of techniques that do consider the time value of money. First, net present value. Here, the name pretty much tells you you're going to find the present value of all the cash flows and net it out. So in terms of a formula, present value of the cash inflows minus present value of the cash outflows. And this never ignores any cash flows. All right, you're going to have to identify the discount rate, so your problems will tell you things like the discount rate or the minimum rate of return or even the cost of capital. They're going to identify that for you. Once you calculate net present value, you will note that if it's 0, the project's return is equal to the discount rate. If it's positive, the project's expected rate of return is greater than the discount rate. So in either of these cases, it's an acceptable project. However, if net present value is negative, then the project's return is expected to be less than the discount rate. So that means that it's not expected to earn the minimum desired rate of return. So it's not a good project. If you have to rank alternatives using net present value, the higher the net present value, the more attractive the investment. Net present value does make some significant assumptions. The first one is that the cash flows occur at year end, so whatever cash flows you get, they occur at the end of the year each year. Then you also assume that the funds are reinvested and are earning the discount rate. All right, profitability index. This is really useful if you're trying to rank competing alternatives. And so you can take the net present value and divide by the net investment required. This way you're looking at how much am I getting in terms of net present value relative to what I'm having to invest, because you tie those funds up and can't use them elsewhere. Note that net investment required, the net initial investment, is going to consider the cost of the asset, but it's also going to subtract proceeds from sale of an old asset. So think in terms of if you were buying a new car and you were going to spend $30,000 and you sell your old car for $5,000, you would think in terms of, well, I just spent $25,000 on a car. So a company that's replacing an asset is going to do the same thing. Then you will add any initial working capital required. Sometimes you have to earmark funds that you're going to use for the project to buy materials or pay labor so that you're sure you're able to meet the expenses of the project. And so you will add that to your net investment required. All right, the last thing that we want to look at is called internal rate of return, and this is what causes the present value of the inflows to be equal to the present value of the cash outflows. In other words, it's where net present value is zero. This particular technique tries to answer what rate of return is the project expected to earn. So think net present value asks, does it meet the minimum? Whereas internal rate of return asks, what rate do we think it will earn? Now, to find the internal rate of return, it is a trial and error process. You will recompute net present value using different interest rates until net present value is about zero. Note that you are responsible for understanding the process and the interpretation, but you are not going to have to calculate this on the exam. Because it is trial and error, it can be rather time consuming. All right, so we've looked at these techniques that help us evaluate the cash flows related to making a long-term investment. Recognize that we are going to do a post-audit of the investment, and we would do this periodically. Since these assets may have a 10-year life, we are going to see if our results align with what we thought was going to happen. And we'll just use the same techniques but using actual information. And based on that, we might modify our assumptions. We might abandon the project or modify the project. We don't want to wait 15 years to see if it was a good idea. We want to evaluate throughout the project's life. And this will, of course, help managers be honest about what's happening, and it'll help us in our entire capital budgeting techniques. All right, so we've looked at the techniques that you will use to evaluate long-term investments. Now we'll need to work some problems.